people, aren't we? I mean, everybody has their opinions about the market. Some people's opinions count for more. Okay, it's not a democracy. Some people do get a bigger vote, and they vote with their wallet. So if you have more money, you get more say in the marketplace. You can drive prices farther. You can get better execution. You can get better fills, better information with money when you get on the inside, as it were. So what Cecil is going to be showing you, it has elements of the typical mechanical system where you just test and trial and error. But that was only after the original theory was made, which is, when you look at people as a group, we like to think we're very individualistic, but when you put us in a herd, boy, we're just predictable. How many of you ever seen a picture of a riot, right? I would think there were some even in Florida a few years ago, right? Well, hasn't it ever boggled your mind that you see 15,000 people and like 8 cops, and they're just beating the shield and everybody backs down? Well, it's a similar thing in the marketplace. When you get investors or traders all thinking in one direction, it's very difficult for them to break out of that. And the professionals know that. They've known that since the 20s. I mean, if you go back and read Reminiscences of a Stock Operator, all the books that I talk about, the reason I talk about them is so you'll get this perspective that, man, these guys have been practicing this stuff for a long time. And they're practicing it on us, on you. So what Cecil is going to talk about are some of the ways to break all of that down, all the behavior psychology and all the stuff. I mean, we'll talk about the stuff that goes behind it so you can do more research or just have the proof for it. But in the end, we're going to distill it down to a very few simple things that you can look for on a chart to know, okay, the time is right. How many would like that? Yeah, okay. And partially the reason why you're starting to see the software coming out, the Hercules software, the TF2W trading system, which I'm developing with Stan Hoffman. He couldn't be here. He actually still likes his job for some reason, but he'll probably chuckle at that when he sees the tape. But he wanted to be here. But he and I have been working on this system, distilling it down to a very similar fashion to what you're going to get from Cecil. Cecil is, I think, more regimented. So for those of you who want something that, look, just give me the rules. Tell me to look for this, this, and this. And when you see those 3 things, you see the red one, the green one, and the other green one, that means buy. Right? Would anybody like that? Okay, that's what Cecil's going to be talking about. So let's get into Hercules. So if you will open your hymnals. This was an early version that you're seeing on the screen. That's designed for a trader. What you see in the Hercules software that you can download with just the squiggly lines on it and the 1s and 2s and 7s, that actually was designed for everyone else. And if we can get this version stable, I'll give it to those of you. I know there are some engineers in the room who would just love to tweak and prod and poke with the numbers. So, let's talk about the Japanese Yakuza. In Japan, coming into the 90s, there was a huge boom. I don't know if any of you remember that. It got to the point, much like in the U.S., in fact, when I went short the S&P the first time, it's because of this story. In Japan, they were making a lot of money, right? Real estate was going through the roof. Their Dow was 30,000. I mean, it was just going like gangbusters. Well, the Yakuza are very entrepreneurial. Now, granted, they're also doing some nefarious things, but they are involved in legitimate businesses. So part of what they did was put their money into the markets. Well, you'd think, because they are the Yakuza, that they would have better information, and sometimes they just don't. And they were in at the top with everybody else. So the Japanese market started to topple, and it started to get heavy, is what we would call it, on the trading desk, meaning it's tough to move inventory. If you're coming into the market with more inventory, meaning you're trying to sell it, when something is heavy, it just means you can't unload it. I can't find anybody to unload this crap on. So the Nikkei started to come down. Well, unlike the U.S. government, the Japanese government is pretty transparent. And they came out and said, well, we're going to prop up prices. And companies started talking about doing the same. Well, it wasn't working. Much like George Soros and the other traders when they broke the back of the Bank of England, everybody found out that you can't stop the market. When people want to get out or there aren't any more buyers, guess what? It's going down. So, unbeknownst to most of the trading world, the Yakuza actually had some very large positions from what I understand. A lot of money. Because to them, it was like a printing press, and it was actually legal. They weren't going to have jail time. So as the pressure mounted in trading circles, and it was subtle pressure at first, I'm sure, but as that pressure mounted, there really was a push to figure out, can we predict where price is going? And it was more a byproduct of the pressure from the mob, basically. The mob wanted to make more money. They wanted to find out, how can we stop the bleeding? Is there a way that we could have predicted this? They were very ingenious in what they were trying to do with the marketplace. So what did they do? And I realize I don't have my slides on the new computer, so bear with me. All right, turn to page 3, if you will. I don't know how they did it, but the Japanese researchers actually got over 5 years of data directly from Reuters. Now, Reuters is basically the clearinghouse for Forex transactions on the interbank market. Okay, for all the big banks, they'll tell you who bought what at what price. So the Japanese got all this information, and they started looking at it. And they were looking for tendencies. Now, we've got to talk a little bit about a factor of us, humans. We tend to make connections really fast, don't we? Meaning, we connect things to events, right? So if you walk by a table and you stub your toe, you walk by a table and you stub your toe, the table stubs toes. Right? In Dallas, I have made an example of this. I made a gesture with my hand. You already expected it. You were anticipating it after just 2 or 3. So what the Japanese researchers wanted to do was to see, do prices cause price? Let's think about it. All we're looking at are squiggly lines on a chart, folks. Do the squiggly lines move price? Are they actually, pushing price up on the chart? Is your computer influencing the tens of thousands of traders in the world? No. But they wanted to be sure. They wanted to see, were there certain things in the market that actually caused? And I won't bore you with all the details, but they were doing a regression analysis and very sophisticated statistical stuff that immediately went over my head. I can give you the links to the papers if you want to look at them. But they took this mound of data, they started crunching it, and they said, wow, you really can, with a certain degree of certainty, predict the markets. Now that should